Hi everyone, I'm Paul and welcome to my review of Lesson 40 of ICT's 2022 Mentorship Program. This is the second last lesson review in the Mentorship series, and in today's video we're going to be discussing daily bias and intermarket relationships. But before we do, if you enjoyed today's video, please give it a like as that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. These are quick, easy and free ways for you to support my channel. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can sign up for my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's video is Lesson 40 in ICT's 2022 Mentorship Program. And we'll just quickly go through the outline of today's video. So the first two trading concepts we're going to talk about are keys to daily bias and intermarket relationships. And we're going to use some trading examples to go through those intermarket relationships or explain those intermarket relationships using the US dollar CAD and the ES or the S&P on the 21st of June. We'll start today's video by talking about the keys to daily bias. Now ICT went through daily bias again in lesson 40, so we've talked about daily bias throughout the mentorship program, but now we're obviously at the end of the program. It makes sense to do a review of that again. And so these are the points that ICT made during that video, and we'll just run through those now. And what I've also done is just added in some additional points just to give a bit more color around these points that ICT made in that video. So the first one is that everyday bias is unrealistic. And what ICT means by that is that you don't have to try and determine the daily bias every day, and you don't have to get it right every day, because what we're really trying to do is determine the likely weekly expansion. So that's really just the direction that the market that we're looking at is going to go over the course of the week. And so then how do we determine what the weekly expansion will be? Is, well, we're going to look for the obvious liquidity in that particular direction. So we're going to be looking for the obvious draw in liquidity on that weekly chart. And so how do we do this? Well, we do it by identifying imbalances in price delivery top down. And so what that means is we obviously look at our weekly chart and then we go top down. So we go down to our daily and then maybe to our hourly or 15-minute charts, whatever the charts that you're using. So you use that top down analysis, and you're obviously looking for imbalances or draws on liquidity from that weekly analysis all the way down. And then most importantly, what we're also doing is focusing on the high or medium impact calendar events, and we'll do that in the trading example we're going to talk about today. And we're using those to support the narrative of the weekly bias that we're starting with. So if we're expecting a downward direction for the market in the week that we're looking at, then we'd be looking in the week ahead for any high or medium impact news events that are going to precipitate that kind of move in the market that we're looking at. And then finally, in terms of how we actually implement, we're then looking for directional price runs, so in the direction of our bias during the specific kill zones that ICT has been teaching. So that's obviously our London Open, we have our AM session for New York, we have our PM session, and so on. And there's obviously macros and stuff that sit inside that, which we can also use to our advantage as well. And so just fleshing out a little bit more on some of those points that I think are worth dwelling on a little bit more is that the first one, and ICT does mention this in the video, is there's not the expectation to know the bias of every single trading day. And so obviously if we're looking at the direction over the course of a week, then that's 5 trading days, and the market's just not going to go to the direction that we're anticipating in a straight line. It's going to go obviously up and down over the course of that week. And so that really releases us from the weight, if you like, of trying to need to determine the daily bias each day. We're just really looking at where the direction is for the week. And obviously if we're looking at the weekly direction, then we'd be studying the weekly chart. Makes sense. And then what we're going to be doing is trying to determine if price is going to run to an old high or an old low, because remember, we're looking for where the draw in liquidity will be, or we're looking for an imbalance above or below the current market price. So these are going to be our draw and liquidity and are going to allow us to anticipate the direction of the move and the size of that expansion. So whether it's going to be a large expansion week or a small expansion week, we don't actually need to know where it's going to close or what price it's going to close at. Again, we just want to know what the direction of that move will be and whether it will be a big move or a small move over the course of that week. And the reason why it's important to focus on the high and medium impact news drivers is because these are the events which are going to provide, the fuel to the direction that we're looking at for that weekly expansion. And this also helps us to isolate what those sweet spots in the week are going to be so that we're then only trading around those events because we're obviously expecting the expansion in the direction we're looking for. And by following this method, it allows us to not be wed to our screens and have to trade every day. We're just isolating those particular sweet spots in the week and we're structuring our whole trade around those particular news events. So if we do these things and we follow this structure, it means that we don't actually have to trade every day. And whilst it sounds counterintuitive to people who want to become full-time traders, trading every day actually leads to all the kinds of behaviors that increase your losses and eventually potentially lead to blowing up your account. So as ICT's said many times throughout the mentorship program, if you have an edge, you don't want to use it all the time because you'll eventually dull that edge and that leads to lots of these bad outcomes. And so finally, I think the biggest piece of advice I can give to anyone around daily bias is that experience really is key. You just have to do this many, many times. You're going to be right sometimes, you're going to be wrong sometimes, but it's just like so many other things, you've just got to do the reps and you will get better at it over time. You just have to keep practicing and practicing and practicing. So the next topic we're going to discuss in today's video is intermarket relationships. Now, this isn't the same as correlation, although correlation is a factor in intermarket relationships. What we're really just talking about is using other securities or other asset classes to help build confluence in the trades that we're going to be taking. And so really all we're trying to do from this analysis is determine whether it's a risk on or a risk off environment. And so what does risk on and risk off mean? Well, risk on means that we're expecting higher prices for risk assets, and risk assets are things like stocks, FX, that is US dollar denominated, and crypto. And when we say it's risk off, that means that we're bearish on those assets. So we're expecting lower prices in stocks, FX, and crypto. And so if you've been watching ICT on YouTube or even on Twitter, you'll often hear him talk about high resistance or low resistance liquidity runs. And so that's really what intermarket relationships are all about. So for example, if it's a risk on environment, that means we're expecting, stock indices like the S&P 500 to go up. So we'd be wanting to take long positions in that environment. That would be a low resistance liquidity run. If we were taking short positions in that kind of environment, that means we'd be effectively going against, the current, if you like, and it'd be much harder to get profitable trades in that environment. It's obviously still possible, it's just making it more difficult for yourself. And so obviously what we want to do is always be stacking the odds in our favor, and so that's why we're doing this analysis. And so that leads us into the trading example that we're going to be looking at today. So we're going to be looking at the US dollar CAD, and that's obviously a bit of a bellwether for whether it's a risk on or risk off environment, because it's obviously got the US dollar as the numerator, and that's going to then inform us in terms of the type of trade that we should be taking on the S&P 500 being a risk asset. So let's jump into the charts and take a look. So we're going to start our analysis today by looking at the US dollar CAD. So that's the US dollar versus the Canadian dollar. And it's important to keep in mind that the US dollar in this case is the numerator and the Canadian dollar is the denominator. And the reason why we're looking at the US dollar CAD is we're going to use this to help build this intermarket relationship that we've talked about earlier in the video. And so in this example, if we're bearish on the US dollar CAD, so we're actually bearish on the dollar in this example because that's the numerator, then that means it's a risk on environment. So remember, when the dollar is going down, that's bullish for risk assets. So it's a risk on environment, which means it's going to be bullish for risk assets, which is our stocks or stock indices, US dollar denominated currencies or foreign exchange, and cryptocurrencies. So looking at the daily chart on the US dollar CAD, you can see we have this high up here where we have our buy side liquidity residing. The market has rallied up into that level, and then we've painted a swing high here. So our swing high, remember, is a 3-candle formation where the high of the second candle is higher than both the first and the third candle. So you can see the high here and the high here are both lower than the high on the middle candle here. So we're actually sitting on the 20th of June here, and so we'll tick it forward to see what happens. But before we do, what we'd be anticipating once we've painted a swing high and we've taken this buy side liquidity is that we'd get an acceleration to the downside. Now, just to go into a little bit more detail before we click that forward, you'll see here we have a down close candle here, which is our bullish order block in this whole move. And so we've marked out the open of that bullish order block there. And so what we'd be anticipating, and we've obviously marked out the whole order block here, is that we'd be expecting price, once we've created this swing high and we've taken out that liquidity, is that we get an acceleration to the downside. Of course, the question is how big is that expansion going to be? We can use the order block to help anticipate what that might be. Now, the order block is going to act a little bit like resistance in this move. We're going to expect this to support price because we're in an uptrend, and our down close candle is going to act like support in that environment. And so what we've done is marked it out into quadrants, and specifically we're looking at our mean threshold, this 50% level on the order block. So what we'd expect is for price to draw down into this level, and we'd expect to see some resistance around that 50% level. It's not as likely that we'd trade through that, and certainly if we did, we'd get a bigger expansion if that was the case. So let's just click that forward and see what happens. And you can see this is pretty much exactly what we get. So we get an expansion lower, which is what we'd expect after this swing high was painted and after the liquidity was taken, and we've traded down into that mean threshold of that order block. So that's what we'd be anticipating based on that behavior that we've seen before that. So we'll go a little bit deeper now into a trade that we could be potentially taking in the US dollar CAD. So remember, we've got a bearish bias for the US dollar CAD, which means that we're bearish on the dollar, but we're bullish on risk assets, which means we're bullish on the S&P or the ES, which is a trade that we'll be taking later. So just keep that in mind for when we start looking for trades on the ES later on in the video. So we've zoomed into our 1 hour chart now, and we can see that liquidity grab that we've had here, and then obviously that trade downwards back into that bullish order block that we're talking about from the daily. And you can see this green line here is that 50% level. So the purple line that we have here is actually midnight New York time, and you can see as the market's traded down into the new session, so into the 21st, we've got our dealing range complete here. So from the swing high to the swing low here, we have our threshold, our 50% level, our equilibrium level just here. And you can see as the market's then going into the New York open, so into that New York kill zone, the market's traded up back to equilibrium, and we've gone into this bearish fair value gap that we've formed just here, which is inside our premium market. And you can see this is where the market has then reversed. We've actually come up to that 75 or 25% level in that bearish order block, and you can see the market has then immediately reversed back down, traded into the bullish fair value gap, which we formed in this discount market, and has then consolidated in that level there. So what we're going to be doing is looking at the trade that we potentially could have taken if we were looking to go short, because remember, we have a bearish bias in the US dollar CAD. Once we'd come back up into this premium part of the market, remember, we always want to be going short in a premium, and we're using this bearish fair value gap in our premium part of the array to go short. So we're going to zoom in now to our 5-minute chart and have a look at the potential executions that we could have taken at this level. So we've zoomed in now to our 5-minute chart on the US dollar CAD, and I'll just quickly run through what we're looking at on the chart because there's quite a bit going on. So this is midnight New York time. We have our New York kill zone here from 7 o'clock till 10 o'clock, and our London close from 10 until 11. So this is obviously the 21st of January. So that's that new session that we're looking at. So we can see as we've come into the new trading day, so past midnight, we've traded into that bearish fair value gap and then sold off, and then the market's traded higher. So this is that dealing range that we were talking about on the hourly chart. and the market's then traded higher. We've traded back up into that bearish fair value gap from the 1 hour chart and obviously into a premium market there. And in the process of doing that, we've taken out the buy side liquidity that we created in the earlier part of the session just here. So keep in mind, this is all leading up to that high impact and medium impact news drivers that we're expecting from the Canadian market, which is retail sales, and that's coming out at 8:30, which is just here. So you can see I've marked that with this little exclamation mark just here. So you can see after we've taken out that buy side liquidity, we've reacted to that and the market has then traded lower. We've actually had a market structure shift here, but it's not been, the kind of powerful displacement we'd ideally like to see. Even saying that, in that process, we did create a bearish fair value gap just here. And you can see after we had that market structure shift here, denoted by this little light bulb, the market's traded back up into that before selling off again. And you can see in this instance, we did get that big displacement, which is exactly when that news driver came out here at 8:30. The market's then traded back higher. We did get a small fair value gap created there. The market's consolidated around that level before eventually touching it one more time before selling off. We've come back down into the discount part of that dealing range that we talked about on the hourly chart, but we've also obviously got a dealing range that we've created here on the 5-minute chart after we've run from this swing low here to this swing high. We've still come back down into the discount part of that dealing range as well. And you can see we have confluence between the bullish fair value gap that we've created here on this 5-minute chart and also with the bullish fair value gap that we created on that 1 hour chart here. So you can see we've traded down into that level. We've gone into that London close. The market's retraced back, and ICT often talks about as you go into the London close, if you're trading FX, you should have about 80% of your position off at this point, because you can sometimes get those positions reverse against you. You can see that did happen here, although it didn't completely reverse, before selling off again. And then obviously the sell side liquidity that was created here at the bottom of the dealing range in this discount part of the dealing range acted like a draw on liquidity, and prices come back down to this level here to close out that trade. Now, the things that's worth noting on this 5-minute chart is we have obviously two opportunities to get set. We have one here after the buy side liquidity was taken, and then we have another opportunity here after that news driver or that news event came out on the US dollar CAD. So we had both a high and medium impact news driver, and that created another opportunity to go short here. Now, you obviously can go short on either of these opportunities, but the more conservative is to wait for that news event to come out and then take the setup which forms in line with your bias, and then obviously trade accordingly. So in this example, this obviously would have worked in your favor and you would have been able to capture the whole of that move. But just remember, if you do take a position before that high impact news event comes out, that is a riskier proposition, and the chance of you being stopped out, even though you may have been correct because you just get volatility around these news events, is obviously much higher. And that's why it's just a more conservative approach to wait for that news event to come out and then take the setup that forms afterwards. So we've zoomed in now to our 4-minute chart, and what we're going to do on this particular chart is just talk a bit more about how we would manage our limits and our stops based on the setups that are presented to us. So we talked about on the 5-minute chart that we actually had two opportunities to get set going short on the US dollar CAD based on that high impact news driver that came out at 8:30. You can see that here, and that was that fair value gap up here, this bearish fair value gap after we took out the buy side liquidity, and then this bearish fair value gap which formed after the news event. So obviously, because we've zoomed into our 4-minute chart, those fair value gaps look a little bit different now, but we obviously have confluence between the fair value gaps on the 5-minute and on the 4-minute. So you can see this is our fair value gap from the 5-minute just here, and then the fair value gap is actually a little bit larger on the 4-minute chart, and that's again the same situation we have on this fair value gap here. So we can just click these off now. Being from the 5-minute, we know we have confluence at those levels. We don't need to keep them on there. And we'll actually take this higher fair value gap off as well, because we know that we ideally wouldn't take that one because that's a higher risk entry. We're going to wait for that more conservative entry. Now you can see what's happened in this case. We got that displacement we were looking for. So even though we had our market structure shift here at the little red light bulb, we actually got the kind of displacement we're really looking for in this move here. But because this move was too quick, often in FX, we'll have a full retracement of that gap. And so then the question is well, where would you put your limit? Because ideally in the normal rules, based on how we would trade stock indices, you would have your limit at the high of that third candle there. But we obviously know we still have a fair value gap up here. So we know that price can trade back up into that level. And so in terms of our risk management, and to prevent being stopped out unnecessarily, we'd want to be placing our stop regardless at this high just here, or even potentially this high here. So that's going to give us that protection against a run higher up into that fair value gap. Now, one of the problems with putting our limit down here is we then got quite a lot of risk. And we obviously, as I mentioned before, know that price is going to trade back up into that fair value gap. And so then the question is well, where do we place our limit? So ICT doesn't actually mention it in this particular video, but in the streams that he's been talking about in 2023, so for the 2023 mentorship, he talks about consequent encroachment, which is effectively the 50% level on the fair value gap. So what we've done here is just marked out our dealing range, and we have our 50% level here just roughly. And so what we're using is that as basically our limit. So I've just marked these out here so you can see we've got 129.56.8 and 129.44.1 here. So we'd have our limit order sell here and our stop up here. Now you don't actually have to have the limit at that consequent encroachment level. You can have it anywhere between the 50% level and the low of that first candle. It really becomes up to you, but you wouldn't want to have it lower than that 50% level. And so in this example, assuming that we did use that as our level to get set, if we put our sell in here, we would have our limit to sell here. We would have our stop up here at 129.568. And then remember, we would be taking our first take profit in our discount part of the dealing range, and we'd be looking at, one of the arrays that we would be selecting. In this case, we have an imbalance here, a bullish fair value gap that we'd be looking to trade into, and we'd be wanting to do that before we come into the London close or this profit taking hour, because as I mentioned earlier in the video, there's the potential for the market to reverse on us in this particular part of the trading session, and we could effectively round trip a profitable position. So ICT always talks about taking 80% off prior to the London close, and then in this example we would then look for our run to the sell side liquidity that was formed down here at the bottom of our dealing range. And so if we'd done that in this example, we would have got a risk reward of about 1.75, and if we'd held all the way down to that sell side liquidity, we would have had a risk reward of a bit over 2.6. So that's a pretty good trade, and obviously is conforming to all of the rules that we talked about earlier in the video in terms of how we structure our trades around our bias and around these high impact news events. So we're switching across to the S&P 500 or the ES, and we're looking at the daily chart. Now keep in mind that we've already done our analysis on the US dollar CAD. So even though we looked at a trade there, we're really looking at that particular security or that particular market to make a determination using our intermarket relationship about whether it's a risk on or a risk off environment. So we're bearish on the dollar, so we're bearish on the US dollar, so therefore we're bullish on risk assets, which means we're bullish on the S&P. So we're expecting higher prices, but still what we want to do is our analysis independently on the S&P and make sure that that is in line with the analysis that we've already done on the US dollar CAD, so we have that confluence. So obviously we want to see higher prices in the S&P, but that needs to be backed up by the analysis, which we'll do now. So if we look at what the market in the S&P has done, we've had this downward shift. We've taken out the sell side liquidity at this swing low here, and now we've taken out the sell side liquidity here also. But you'll notice the difference in the two markets. So in the US dollar CAD, after we'd taken out the buy side liquidity, we'd actually painted a swing high, and that's not the case, or the opposite case of what we're seeing here in the S&P. So we have taken out the sell side liquidity, but we haven't painted a swing low. So the low of this candle is actually lower than this candle, and we'd need to see the next candle to confirm if we actually have a swing low or not. But based on the formation of this candle, so you can see this is a spinning top type candle, and that's often a marker of indecision. And we've also taken the sell side liquidity, is we'd anticipate, or we'd hypothesize, that the next draw on liquidity is going to be to the buy side. And so above the current market price, we have this bearish fair value gap, and we also have this volume imbalance. So both of these structures are going to act as a strong draw on liquidity, and considering we've taken the sell side, we'd expect price to draw towards that buy side now. It may not necessarily trade up into those levels, but we'd expect that to be the draw on liquidity. And so in this case, we're again hypothesizing higher prices in the ES. So we have a bullish bias, which is confluent with that analysis, that intermarket analysis we did on the US dollar CAD, which is showing that we should have a risk on environment. So as ICT talks about throughout his Twitter account and so on, is we're looking now for long setups. We have a bullish bias, and we have a risk on environment, which is going to give us that low resistance liquidity run, which is the kind of environment we want to be taking long positions in. So we've zoomed into our 1 hour chart now, and we're just going to use this to help frame up our trade a bit better. So we have our dealing range from our swing high here to our swing low just here. And you can see that in the dealing range, we obviously have our premium part of the range and our discount. So the market's traded down into a discount. We've created this sell side liquidity. The market's then taken that out. It's reacted to that sell side liquidity and then traded up back towards equilibrium and into a premium. And it's then come up into this bearish fair value gap in the premium part of the array, and it's then consolidated at that level. So what we're going to be looking at is the trading from the 21st. So that's from this part of this session onwards. And remember, we have a bullish bias. We know that we're in a risk on environment. And so we're going to be looking for long setups going into this part of the session. So we've zoomed into our 15-minute chart now, and I'll just outline what we're looking at just so we can orientate ourselves on the chart. So we have the beginning of the session here at midnight New York time. That's in purple. We have our London Open kill zone, so marked between 2 o'clock and 5 o'clock. And we have our New York AM session between 8:30 and 11 o'clock. And so this is the particular part of the session that we're looking at, but we'll just walk through each of the specific sessions and just follow the price action from there. So we can see before we come into the 21st, we have this bullish fair value gap, which is formed here. And if we draw that across, you can see after we come into the midnight open, the market trades down into that. It reacts to that bullish fair value gap and then immediately trades higher. In the process of that, we take out this short-term high here. So we get a market structure shift, which is bullish. And so we've come into our London kill zone here. We take out the sell side here. So we trade into this bullish fair value gap before trading higher, taking out the buy side liquidity here. We paint a high here, and you can see this becomes relative equal highs as we go out of the London kill zone and as we come into that New York part of the session. Now, one of the things that's worth noting as we come into London, so often either the high or the low of the day is painted in London, and you can see in this example the low of the day was actually painted in the kill zone. So that happens quite consistently. It's obviously something that we can use to our advantage, especially when we're employing power of three and some of the other ICT concepts in our trading. So in this example, the market trades back down below the midnight open as we come into the start of that New York kill zone. You can see the market trades into this bullish fair value gap that we have that was formed in this expansion here. And you can see the market's traded back down into this order block, which was formed during the London kill zone. The market's then reacted to that. We've traded higher. And then as we've come into that New York AM session, we've traded back down into this bullish fair value gap again before trading higher, we take out these relative equal highs, and then we trade right up into that bearish fair value gap that we talked about on the hourly chart, and that acts as our strong draw on liquidity, which is where we finish at 11 o'clock before lunch. So we're looking now at our 5-minute chart, and specifically just around the beginning of this New York AM session. So you can see as we come into that part of the session, we have our dealing range formed here from the swing high down to this swing low here. You can see the market trades up just as we hit 8:30, which would obviously be confluent with that news event we were talking about on the US dollar CAD before. You can see that takes us back up into the premium part of the dealing range, and you can see we have a bearish fair value gap there, which the market trades into. We get a reaction from that. We come back down into the discount part of the range, and again we trade back in to that bullish fair value gap which formed on the 15-minute chart, so you can see that here. But we also have a 5-minute fair value gap which formed also in our discount part of the array in this move on the 5-minute chart. So we have a largely confluent bullish fair value gaps at this level. The market reacts to both of those, and we get this expansion upwards. Again, we take out the buy side liquidity, we get this big expansion here. You can see there's another fair value gap which is formed, another bullish fair value gap which is formed here in concert with this swing high that we have here. The market trades back down into that before accelerating again into this bearish fair value gap which we marked out earlier in the video. That's acting as our strong draw on liquidity, and we come right to the top of that fair value gap to hit our target. So we're zooming in one more time to look at the actual executions. Now, I apologize again, I don't have the data back to this point, so we've just taken a screen grab from the lesson that ICT gave. So the market trades down into those bullish fair value gaps that we talked about on the 5-minute and the 15-minute chart. We get a consolidation here before we react to those levels. You can see the market trades higher. We get that displacement we're looking for. There's a short-term shift in market structure just here where we have that little light bulb, so the market trades higher. You can see we get these two highs here which forms that buy side liquidity, those relative equal highs just there. And then we come past that 8:30 news driver event, the market trades back down. So there's the bullish fair value gap just here, and obviously you could have traded into that off this candle here, but if we were waiting for that 8:30 news driver, then we would have waited till after this period here. This obviously would have been taking that position prior to that news event, which is obviously just a riskier entry. This would be the more conservative entry over here. So you can see the market trades down. We dig right back into those bullish fair value gaps and into this particular setup we have here on the lower time frame. There's actually a bullish order block just here, so you can see the top of that would be just here. And then we have another fair value gap that is formed here, which is marked out by ICT in the slide as well, so you can see that is confluent there. So we have a lot of confluence in this area. We have bullish fair value gaps on the 15 and the 5-minute. We then have another bullish fair value gap that was formed just before 8:30. We have another one after 8:30, and we have an order block or a bullish order block that was formed after 8:30 as well. So you can see the market trades back into that. We completely fill in that imbalance before the market trades higher and consolidates and then races off. Now there's a couple of points that ICT made in the video which I think are really helpful in terms of how we structure our trades in the future, and that's about the confidence you can be taking buying at this level. We're obviously taking the more conservative entry because we're waiting until after that 8:30 news driver, but the things that we can see is that after this sell side liquidity was taken just here, so we know that all the sell stops have already been rated here, so that smart money has already rated these sell stops. That's created that drive up higher, and so when we're buying here we can be confident that the market isn't going to trade lower. We've filled in that imbalance, so there's no need for the market to come back and fill that. And we also have all of these sell stops having been taken by this additional thrust down, so that gives us a lot more confidence going long in this particular area just here based on the setups that were provided to us. So the thing to keep in mind as we come to the end of this video is that we were looking at the US dollar CAD, and we were looking at that particular market because we were trying to determine whether it was a risk on or a risk off environment. From that analysis, we knew that it was a risk on environment, which means that if we had a bullish bias going into looking at the ES, which we did, then we know taking long positions would be a low resistance liquidity run in terms of taking those long setups in this market. And you can see that's what happened. We took that position, it ran all the way up to the premium part of the dealing range, into that bearish fair value gap, right to the top of that fair value gap, which is what our target would have been. And that's specifically what ICT is talking about when he talks about these low resistance liquidity runs. And so this is just a way that we can build confluence and also just increase the probability of having a successful trade. Thanks for watching my review of lesson 40 of ICT's 2022 mentorship program. I hope you found today's video on daily bias and intermarket relationships helpful. Daily bias is one of those areas that lots of new ICT students have difficulty with, so hopefully today's video helped you understand that a bit more and create a bit of a framework for you to build out your analysis. We also saw in today's video how intermarket relationships can allow us to understand whether we're in a risk on or a risk off environment. Introducing this concept into my trading has definitely made a big difference, and I'm sure it'll make a big difference to yours as well. So hopefully you gleaned some helpful insights from today's video, and if you did, it would be great if you could like this video because that's going to help other people to find it. And if you enjoyed this content and you'd like to see more of it, then make sure you subscribe to my channel and turn on notifications so that you never miss an update. Remember, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.